Welcome to The Derivative by RCM Alternatives, where we dive into what makes alternative investments go, analyze the strategies of unique hedge fund managers, and chat with interesting guests from across the investment world.
Hello, Dark Days here with our vol spike topic for this episode, caused by news that Russia was in fact invading Ukraine. We talk financial markets and strategies on here, but should remember that there's real people in real danger out there. So our hearts go out to all those in the path of war and the human tragedy that will unfold over the next several weeks or months. It's not going to be easy. For today's pod, with VIX shooting up to its highest levels in a year, we phoned a VIX friend, so to speak, getting Brian Stutland, CIO of Equity Armor Investments, to join us on short notice. Brian used to be a market maker in the VIX option pits and now runs Equity Armor's strategies, which use their EA Vol Index to essentially replicate the VIX. We cover what this morning was like in comparison to 2020 and 2008, why is the VIX an imperfect benchmark for vol, and what the rest of the year may have in store for the VIX. Send it. This episode is brought to you by RCM's professional team of advisors that help investors research and access hundreds of professional managers in this space. Check out everything RCM does at www.rcmalts.com. And make sure to check out our newly updated VIX and volatility white paper, as well as the trend following white paper we put out last week. Just click the education tab and then white papers. Okay, back to the show. All right, hello everyone. What a day to have a VIX specialist on. We're recording this around 11 a.m. Thursday, February 24th. U.S. markets were down about 2%. European markets down 4 to 5%. The Nikkei was at a 15-month low. And our old friend, the VIX, was up in the 30 handle all this morning. Brian and I were going to record actually at 9 a.m. And the market was so crazy, we pushed back to 11 a.m. here. So we've rallied back a bit. I think Nasdaq went positive. Now it seems to be turning over again. So quite a day, Brian. Thanks for coming out of the foxhole for a bit to chat with us.
Yeah, it's been quite a day, quite a night, quite a last few days for sure for the markets here.
I was playing paddle tennis, which listeners outside Chicago might not know, but in the northern part of Chicago here, that's a big deal. But last night, a guy actually left the paddle hut because he's checking his phone. He's like said something about margin call and ran out the door. I'm like, okay, this is happening.
Yeah.
So tell us, we've got Nasdaq entering a bear market down more than 20%, S&P in a correction down more than 10%. So let's just start. Explain what you're seeing in the vol space generally and option prices locally and anything you got.
Yeah, well, certainly, it all really started when the Fed started talking about pulling back liquidity, essentially, right? That they were going to stop buying bond purchases, the market basically anticipating rate hikes. And then obviously the news on Russia and whatnot, invading Ukraine has, glorified the level of volatility in the marketplace. And so I think what we saw is once the liquidity started to realize maybe it's got to pull back a little bit, all this volatility crept in. And you talked about the Nasdaq entering a bear market down 20%. Well, when interest rates start moving higher, at least on the back end of the curve, historically, that's not been great for the Nasdaq because those top names, what I like to call, if you're a right-wing political person, MAGA, Microsoft, Apple, Google, Amazon. If you're left-wing, you can add a Tesla in there and make it MAGA. But those stocks really lead the Nasdaq, and they do very well when they can borrow for cheap, right? So when they can borrow cheap and either buy back stock or acquire other companies that have been fallen in value, it's great for them. So a rising interest rate environment is not. That's led to a lot of volatility. They make up a big component, not just of the Nasdaq, but the S&P 500. So certainly that has been the reason for all the volatility in this marketplace is really coming from those large cap value names and the growth sector in general having a very tough time.
And what were you saying this morning in particular in terms of were option spreads blowing out? Where VIX was hit 34? So it wasn't like March 2020. We weren't going into the 60s, 70s, 80s, but give us just a little behind the scenes look of what the actual plumbing was looking like.
Yeah, well, I mean, I think when we looked at March 2020, we were seeing 4 or 5% moves in the stock market close to close, then all the level of intraday volatility to go with it. Now, we're not quite seeing that level, definitely high levels of volatility, but not quite those moves. And that probably warrants a pretty lower VIX, not the 60 or 70 VIX or 80 VIX we saw in March 2020. The market moving 2% or so, it is very volatile. It's tough to be an investor in this market, but it is also warranting a VIX somewhere in the 30s, not the 60s or 70s.
And contrast one more time with like Lehman crash, 2008 lows. Compare and contrast that one as well.
Sure. I mean, I actually would say this is somewhat comparable to the 2008. 2008, we saw high levels of volatility, but it was a consistent market down, with a couple gaps in place, right? When Lehman collapsed, I remember that day very clearly. The VIX popped extremely hard on that day. There was panic, but then once the sort of the panic settled in, you got into this normalized volatility level, not where normal in terms of like it's fun to be in the market, but normal in the sense that, you got that range of 2 or 3% daily moves up or down, and that sort of became the norm. And that's where the VIX sort of settled in back then as well. Obviously, once we sort of got through the clearance of October of 2008, that brought high levels of volatility. But December and then January 09, February 09, it was more of that normalized move of 2 or 3% that we're kind of seeing today. And I think that's, fairly comparison, which hopefully means the tail end of a bear market as it did in 2008 heading into 2009.
Yeah, it seems a little similar, right? At that point, they let Lehman fail. At this point, they're kind of letting Ukraine be taken. So it seems like a similar thing. Like people like, hold on, you're actually going to let one of these go? Little wake up call for people.
And that I think is why you're seeing the pop in the VIX today that you weren't maybe seeing like a week or two ago, because now people are waking up realizing, you're really just going to let Ukraine go? This, like you mentioned, are you really going to let Lehman go under? So that's what I think we're going to see today. We're going to probably see some higher levels of volatility due to that, the same way we saw Lehman, September, October. We're probably kind of in that time frame comparably versus the December, January, February time frame of 09, where we then saw the bottom. I don't think we're quite there yet.
And then you were saying you think it's a little bullish, actually. What was that comment of like the 08 comparison?
Well, I think when you start the 08 comparison, basically you saw the VIX actually start going down and the market was going down. The VIX going down because the levels of moves in the market were not as great. We kind of settled into a 2% daily range for the market, although that was elevated in terms, it was not increasing in volatility. And so whether you're increasing or decreasing in volatility is more of the key to be looking at. Right now, we're seeing the ball pop. We may get a little bit more shakeout in this market. It may not be over yet. So until we start to see the volatility levels come down, the VIX come down, the daily moves come down, you may see a bear market kind of continue.
And what does that look for you? Like into the 20s or back into the teens all the way? Or you're saying just into the 20s and the VIX would be fine?
Well, I think the S&P's got to get over some key levels here, 4,200 intraday on a close-to-close basis. I'd like to see it close above 4,320. I think if we do that, then you may see the VIX start to come off and get into the low 20s. But with the Fed sort of in play, decreasing liquidity in the market, the normal VIX could be back to where it should be, which is around 20. So the days of low teen VIX, I think, are gone for a little while until the Fed indicates that they're going to stop raising rates. Until that happens, the upper teens to 20 is probably an area where now the VIX, market participants say risk is now, back on again. You can get into the market. So that's probably where the VIX goes if we break some of these higher levels in the S&P. But until then, this feels like a bear market right now.
And give us not to put you on the spot with the math, but give us the math on a VIX, right? A VIX of 32.
Yeah.
Like, what does that mean in terms of daily moves, in terms of weekly moves versus a VIX at 22, say, or 30 and 20?
Sure. Yeah. The way I like to look at it is for every 16 handle move in the VIX, that represents 1% daily moves in the market most of the time. So a 32, double that. So that's 2% daily moves. So when you're looking at is the VIX cheap or not, you have to say to yourself, well, is the market moving 2% a day? If it is, then the VIX is not cheap, right? Because 32 is representing that 2% move most of the time.
Got it. That's an easy one to use. And then halfway would be 1.5% and so on and so forth.
Exactly. Yeah. It's symmetrical all the way up. 48 VIX would, be a 3% move.
which is crazy to think of when it's in like the 80s and it's representing what, like a 6% daily move or something.
Yeah, and that's what we saw in March 2020, right? I mean, that was just levels of insanity.
Just want to backtrack a bit and dive into your personal background. Give us a little bit how you got into the biz, where you've been. Touch on that Michael Jordan last shot. Is that Jordan last shot versus Utah behind you?
That certainly is. It's one of my favorites. That's a guy,
like he kept that follow through, right?
Yeah, right.
Have you ever read about that? He said like he knew he was tired. He could feel his legs were tired, so he wanted to really exaggerate the follow through to make sure he got it to the basket. Like,
yeah,
the go.
That was. I mean, that the reason I love that shot is just representative of when it came to crunch time for Jordan. He was willing to step it up, and he knocked down the shot when you had to. That's what made him the greatest, right? It's just when you needed it, you got it from him.
I heard a great argument to end the LeBron versus Jordan debate. It was like there's one NBA Defensive Player of the Year, 2 NBA titles. It had basically the difference between them, and they said if that was a player, right? If the difference between their records was just a single player, it'd be a first ballot lock Hall of Famer, and that's the gap between the two. So, anyway, we'll move off our Jordan fandom. So, give us a little background. You were down in the pits at one point, right?
Yeah, grew up in Chicago. Went to the Chicago Board of Options Exchange pits right after college in '97. After finishing a degree in chemical engineering and a master's in biomedical engineering from Michigan, and went down in the pits. Traded for some pretty big specialist units down on the floor. Eventually formed my own broker dealer. Went off in my own pit. And went into the VIX option pit right when they listed options. There was maybe like 5 of us trading in there. It was quite quiet. Goldman Sachs, Barclays, SocGen were the very big institutional players in there. Whether they wanted to protect themselves against the housing crisis, when you think about the movie The Big Short, and Goldman being so involved in that, I look back and say, there was a reason why there were VIX. By Goldman was buying upside calls in the VIX, right? Huh. Anyway, so it traded around that and just learned a lot about how VIX moves, how VIX futures move, and how volatility moves relative to the market. And eventually we formed a registered investment advisory sort of to turn our market, making strategies that we developed into market taking strategies and offer that to clients. So left the trading floor in 2015-ish or so, closed up the broker dealer and really focused on just the advisory business and sub-advisory business and capacity that we're portfolio managers on a couple of funds now, and offering all that VIX trading and knowledge to the marketplace and the public.
And so take me back to so what was that, 2010 through 2015 in the VIX pit?
No, 2006, right when they listed options. The futures came on in 2005 and they listed VIX options in 2006. And I was there from the start.
Okay, and so you were there, like we were just talking about, heat of the moment.
9 years.
Oh, wait.
Yeah, heat of the moment, right.
What was that like in the pit days? Insane? Crazy?
Yeah, wild swings for sure. It definitely helped in 2007, 2008. The bid-ask spreads were a little wider. If you're a market maker, you kind of enjoy that, being able to, because you're basically making a little bit of edge in the market, trying to get in and out and manage your book and risk. So the wider the spreads are, if you can buy on the bid of the spread, sell on the ask, it definitely helps. We had some great moments back then. And actually our firm became one of the higher level volume traders in the CBOE electronically. We were one of the top volume trading firms there. So certainly that was, exciting times for us. Obviously 2008 hit, we were able to manage it, have a ton of success. I don't even post returns from those 2 years because they were insane for us. So, Flash crash 2010 was probably the most craziest moment when the market out of nowhere dropped 5 or 6% and VIX, moved from like 30 to 40 in a matter of like seconds. but certainly a lot of times we see a lot of volatility. It seems like, even though these standard deviation moves are called 3 standard deviation moves, they seem to be happening, once once every other year or once a year almost, right? So it just seems like all the high frequency and everything else that goes on in this marketplace is making and driving this level of volatility.
And when you were down there doing the VIX, could you feel that steady increase in the volume and the interest and the institutional participation? Like, what did that
certainly
feel like in real time?
Yeah, I mean, we went from like 5 guys trading in the pit, a lot of orders coming in. How does the VIX future move? And I mean, I remember one order, a guy bought a call spread, a customer bought a call spread, and like literally 5 minutes later, he sold it back out for like 2.5 cent loser because he didn't really know what he was doing. But basically the pit grew from like the 5 or 6 of us standing in there to, a pretty sizable pit. Now, when you go to the Chicago Board Options Exchange, the only 2 open outcry pits left really are the S&P 500 options and the VIX options. So volume really grew. The number of guys trading and women trading it grew. So, it became more liquid and more actively used for market participants to use a better way of hedging themselves rather than just using a put option contract.
And could you feel 2 things? One, who was that guy? 50 Cent?
Yeah.
Like, that would just keep coming in and buying. One, what was that like? Was that you guys knew who he was? I think it's come out since, right? It was like a London hedge fund.
Yeah, you knew it. I mean, it just wasn't him doing that. Obviously, he had his 50 cent program or whatever, but other market participants, similarly, what they wanted to do was own the upside call in the VIX, because on days like today, you get this asymmetric pop, out of nowhere that surprises people. And then all of a sudden, all those call options that you bought in the VIX, playing the VIX to the upside, explode in value. So lots of traders played that. And as a market maker, my job was obviously to sell them that call, but then also trade around that and manage my book so that, I wasn't caught off sides by that vol pop.
And so you'd sell the option, then you're kind of like all these gamma flows now. So then you would delta hedge that, and you were trying to be, what was your strategy in terms of market making? You were always neutral?
Yeah, I was pretty neutral as a market maker. The way I would sort of play it was trying to leg into butterflies all over the place, because that's usually the most neutral option strategy if you're somebody that is more knowledgeable about options. I talk about this in the higher level parts of a book that I wrote on option trading, but the butterfly is usually the most market neutral kind of play. And so as a market maker, you would try and sort of leg in and out into those flies. So if you sold one strike, you were buying something around it, whether it was the same month or a later month, and try and stay neutral. We did, for actually a little bit of time, have a couple guys market making in the S&P and sort of trading S&P versus VIX for a little while as well, to sort of to play those 2 option areas, since the S&P 500 options are built to calculate the VIX.
Yeah. And then the second one, just what was it like? Could you feel the institutional interest, the retail interest in being short vol, right? And kind of, did you feel that playing out with the ETFs coming online and all of that?
Yeah, I mean, you could see that when the short volume or short interest increased to try and play VIX to the short side, whether it was selling a call on the upside or shorting VXX, for example, the ETN tracking the front 2-month futures contracts. When the vol pop came, you could feel those guys just, have to rip out of their positions. I know, a handful of firms that literally blew out on having those positions on and not managing that risk. So, I mean, people say being short VIX futures is the greatest trade till it's not. And then, they go up 100% and you're done. So it's a difficult trade to manage, but you could see the players come in and the level of panic it created when we got these vol pops.
Love it. And then, so like you said, left the floor, started Equity Armor. So you guys run some managed accounts, you run some programs and sub-advise on some mutual funds. And the main takeaway that I have from it is, right, Equity Armor, you're trying to protect the equity portion of the portfolio. So talk a little bit about the main idea there of what you're trying to accomplish.
Yeah, I mean, our handful of strategies, the core issue there in play is using the VIX, using VIX futures to provide a hedge for any long equity exposure or long beta, I like to say, to the market. So if somebody is dialed in some way or form with correlation to the S&P 500 and being invested in stocks, what we like to do is we like to use VIX with that. And there's a handful of reasons we do that. One, we know that over time, we believe stocks go higher. I mean, if you look all the way back to, the Great Depression, 1929, the market is higher, right? At the same time, the VIX kind of acts as like a heartbeat. Yeah, it spikes, but it kind of comes back down. You can't exercise forever. That heartbeat comes back to normal. So VIX sort of returns to this mean, right? So if I own something that is mean and not going to generate any returns, and I own something that's, moving higher, well, now I have two pretty good things. The thing is this mean reversion going to give me protection when the market goes down? And the answer on a daily basis typically is yes. The VIX pops when the market goes down. And so if I get this daily hedge embedded where I have two sort of securities that are balancing each other, but then over a long period of time, I have one that I'm owning that's going higher and the other one that I'm owning that's going to return back to its mean, I can play that seesaw action and benefit from that.
And so embedded in that is the whole concept. I'm using the VIX as a cash machine. When it pops, I can take that, put it back into the equities that are going to generally trend higher.
Yeah, exactly. It's like a farmer. You're gonna sort of plant your crop, plant your seeds. When it comes due, when the corn is ripe, you're gonna pick the corn, right? And eventually the corn is gonna go away. You're gonna have to replant again next year. So we do the same thing. When the vol pops, we're selling out of that volatility pop and buying equities at a lower price.
And talk a little bit, right? That structurally that makes sense. The devil's in the details, right? Because the VIX futures have a constant bleed. They're always reverting to the cash fix price. You can't trade the cash fix. So talk a little bit about that dynamic of like how can you trade the VIX profitably when it seems very hard to actually hold it as a long holding?
Yeah, it is tough to hold as a long holding. I mean, we see the VIX drift lower here, and whether how you held those futures or how you traded the VIX really depends on how well you did. The key is we developed a methodology in order to start to limit some of the decay of a contango market. And by the word contango, I mean, example, the oil markets. When the oil, let's say spot price is at 100, oil futures traders, whether it's storage cost or whatever, the future out month is trading at a higher price than the spot price. So that happens a lot of the time in VIX, where the VIX future out months are trading at a higher price than the VIX. So what happens is if the VIX does nothing, the VIX futures have to come down and settle down into that cash price. And so that's called decay. And so managing that decay aspect of the VIX futures is the key part. And the actively traded part where we use some methodology and tricks sort of to be able to hold long VIX futures, hold that long month VIX future synthetically to play all this mean reversion back and forth in volatility.
But that's right. And a lot of people thought, I'll just buy VXX. I'll buy one of these ETFs to have that long exposure. They're rebalancing, right? They're down 98% or whatever over the history. So, right, that's the kind of the trick of like, okay, if I just bought and hold VIX, I lose all my money.
Yeah.
So
I think the problem that you have there is VXX is based on the calendar. Every day it's going to roll from the front month and it's going to buy a little bit of the second month VIX future. That's what the VXX is tracking. Okay. It's owning the front 2 month futures contracts. It has no idea where the spot price is or where other future contracts are trading. So it's like this systematic program based on a calendar that's owning VIX futures. Whereas we are looking at the shape of the futures curve on how to own it, how to hold it. It's very similar to a treasury trader. You want to own 2-year notes or 10-year notes or 30-year notes, or the euro dollar traders that trade, the shorter term, yield curve, so to speak. There's a yield curve to be traded in the VIX, and that's how we manage it.
And you're aiming for the cheapest part of that curve, essentially, right? So
exactly, yeah.
Yeah. Which it seemed by definition would always be further out, no? But or closer by, right? If it's in contango, you think it's always closer by, but then you're always having to do the continuous roll.
Right. So it's not just measuring, owning the further out. It's how many contracts do you own to replicate the front month contract, right?
Got it.
So
Yeah.
our methodology, our EA Vol Index, which is disseminated by the Chicago Board of Options Exchange, actually they have our calculation, right? And so they take our calculation on how we hold these VIX futures, and they publish, the returns of holding these futures, and so it's an actively managed position on how many contracts to hold and where to move along the curve. That takes a little bit of sophistication to do.
Let's dive in a little bit to all the problems with the VIX as a measure of volatility, right? Like
Sure.
I did a thread, we'll put it in the show notes, back in January, of like a lot of long vol programs struggled in January, even though VIX was up quote unquote 40%, because fixed strike vol was actually came in a little bit. So
Yeah.
talk to us a little bit about those dynamics of like why the VIX isn't always a great measure of what's actually happening underneath the hood in terms of the vol surface.
Yeah, I mean, so I think what's interesting about the VIX calculation is, it measures S&P option contracts, the out of the money puts and calls. Okay, and so it's just an index calculation. What's really embedded in there are two components: one, realized movement, the actual movement in the market, and two, what do traders expect 30 days from now, what the VIX should look like, or what volatility should look like 30 days from now. So it gets a little tricky. Some of the vol traders that like to be long vol, when you're buying S&P options to do that, you're having to really manage those two issues, right? Did I get the realized movement correct? And our future expectations of volatility, can I get that one correct as well? And so that makes it a little bit more difficult. And like you said, a lot of the long vol, firms had maybe some trouble with where the straddle was priced. The reason being was options on the downside were accurately pricing the level of volatility that the market would be at when we got down there. So when the market would move down, those option prices were priced right for the level of movement you would then see in the market. And so it's these two dynamic components: realized actual movement and what people expect. Whereas when you're trading VIX futures, and we're doing it in our model, we're just trading expectations of where the VIX goes. And the VIX has, like we talked about, negative correlation to the market, meaning when the market goes down, the VIX will travel along that S&P 500 option curve and go up in value. So it's very difficult for times to see the VIX go down and market go down. It happens a handful of times per year, but not very often. And so now we're sort of removing these two components, and we're only trading one thing, volatility, and we can just manage that better, and we can rebalance, harvest the crop when we need to, and rebalance with stocks accurately versus some other vol trading groups.
And so would you say, right, people say VIX isn't tradable? Would you agree with that or not agree with it? Like,
yeah, I don't think it is really tradable, right? It's a calculation and a measurement of what these premiums are in the S&P. And because it doesn't factor in time decay or future implied volatility of what's going to happen in the future, it's just that snapshot moment in time. It's not tradable in that sense. So it makes it difficult for traders to play it. And sometimes trading straddles or strangles to get long volatility doesn't always work out the way you want it to happen for those reasons.
And it's a floating band on the market, right? So if we go down 5%, the VIX kind of resets to those options, and it's ignoring the options that were bought at that previous level.
Exactly.
And talk to us a little bit. I got into it on Twitter here too, of like, what are your thoughts on quoting VIX in percent gain? Don't do it.
Well, it is important actually, and it's really a key measure we look for when we're trading our strategies. When we're trading VIX versus long equities, we actually are looking at what's the percent change of VIX relative to the percent change of the S&P 500. I think that's something to keep an eye on. When that ratio drops, to 2 or 3 to 1, it usually indicates a level of comfort that we're at a level where option traders are willing to sell puts in the market and get long the market, is what I find. When we see the VIX move, let's say up 8% for a 1% down move in the market, that 8-to-1 ratio is very high. So those things I do like to watch, and totally ignore the price of both the S&P and the price of the VIX, and just look at the percent change of relative to each other.
Some of the people are saying you can't, if right, a VIX of 20 means there's 20% volatility, a VIX of 40 means there's 40% volatility. It didn't increase 100%, even though technically, right, it's only 20% more volatility, not 100. I can see both sides of it, but it's an interesting debate. So where do you stand? We'll go to another Twitter commentary. Where do you stand on gamma flows? And that's all that really matters. And if you can model where the market makers are, and you were a market maker, and where they have to do their delta hedging, you can glean some information on where the market's going to make a stand or break through.
Yeah, I mean, through time, traders have looked at open interest, they've looked at volume, they've looked just at that. Where are people short gamma and long gamma? Because obviously, as a market maker, if you're short gamma, you're having to sell the market as it's going down, right? Which is then forcing the market lower. If you're a long gamma trader, it means that when the market's down, you're actually buying the market and trying to push it back up. So getting that sense of feel of flow of that actually is important. And a lot of times you can kind of sense that as we get towards like these big strikes in the market. Let's say, for example, S&P, let's say it got down to 4,000. That seems to be like a key big strike level for a trader there. So certainly I do like to watch that. It takes a little bit higher level of sophistication. If you're a trader, you're going to go through those levels of iteration to try and figure that out. If you're a general investor, it's probably a little bit too detailed to try and determine where the gamma is and all that kind of stuff.
And you mentioned before the 4,200 level. What does that have why does that have significance, if at all, or just it's had significance, so it remains significant?
Yeah, I mean, I think 4,200 on the S&P was a low, kind of where we saw at the end of January. We saw that market kind of touch down near there actually just before Russia attacked last night. And if you go back even further in 2021, that was sort of a level that it bounced off of as well. So that seemed to be a support in the market where market participants were willing to buy the market. And I think last night when we saw it crack that level, it was a real indication that maybe the buyers are getting a little bit weaker in hand here. And so that level now becomes a very key important level, whether the market can rally through that and probably push the market significantly higher, or it's going to trade back up to there. And all those buyers are like, hey, I got to get out of this thing now. And then it's going to flush lower. So it's an important level. On the close to close, I like to look at that too, was 43.20 was a level on a closing basis in the S&P is something to watch as well as a sort of support resistance line.
And then I want to circle back on the Nasdaq that we touched on briefly. There's been tons of carnage sort of under the hood there. I think the index finally caught up a little bit, being down 20%, but right, a lot of those ARK names are down 60, 70, 80%.
Yeah, crushed.
A lot of those IPOs down more than 50%. So just two things there. One, have you seen a lot of demand of investors of like, hey, help me hedge this other part of the portfolio, these single names or these higher tech names, not just the index? And two, we'll start there.
Yeah. Well, I mean, I think with the single names, some of these growth names that have, seen wild swings, the thing is in a raising interest rate environment, some of those names become more difficult to own. The level of volatility increases there. And so they tend to lose a little bit of the correlation to VIX, meaning they perform a lot worse. I mean, there's nothing worse than owning an asset class that you're trying to own. And like I talked about, we expect stocks to go up over a long period of time. You're owning something that actually is departing from the broader based stock market and performing worse. Those are names, if you want to use levels of hedging and volatility against some of those names, we encourage people to try and, look for the best to breed in the market. And right now, we've been buying stuff where, think of it as things you need, not what you want. And all those want stocks are just getting hit because they're getting hit without any sort of correlation to volatility. And it becomes a little bit difficult to hedge those kind of names.
And doesn't CBOE have a Nasdaq VIX, but it doesn't trade at all?
Yes,
futures or just the index?
There's two out there. They have a Nasdaq VIX. Also, the Nasdaq publishes a Vol Q, which is their version of Nasdaq volatility levels as well. But again, those aren't really tradable. They tried to, little success to get volume going in those contracts. And so now people just kind of use it as a measurement and indication of what the Nasdaq is doing, where it's at. And actually, we own the VIX in one of our strategies, and we trade. We own the Nasdaq, I should say, as stocks, and we trade that against the VIX, and we just kind of measure up the beta of the Nasdaq versus the S&P to sort of be able to manage that and hedge it.
Right. So I guess you're saying I can still just use the VIX, and I can use twice as much because the Nasdaq's 2x the beta of the S&P or something like that.
Yeah, exactly. There's a rough correlation to that. Now, obviously, the last couple of months, you talked about some of these growth names. That's obviously pushing the Nasdaq down a little bit further than you'd want to see it, which makes it a little bit more difficult to hedge, even if you're at that 2x level or whatever. But yeah, just measuring up the beta exposure. If you can get something highly correlated to the S&P, even though it might have a different beta, then you can use VIX to hedge.
Right. And I guess these days it's even more highly correlated than normal, with a lot of those big names becoming part of the S&P, right?
Yeah, for sure.
And then come back to that interest rate thoughts on, right? Does it make sense to me of tech stocks have a lot of interest rate exposure, right? They don't need a lot of capital. They don't have, right? It's not a airline that has to buy and lease planes and whatnot. So go back to that theory on why tech stocks have that interest rate exposure.
Well, they do, but they don't, right? So the thing is that when you look at some of the big names that I talked about, Microsoft, Apple, Google, Amazon, not only are they in a great position to buy back stock of their own, and certainly when interest rates are lower, they're able to do that cheaper, right? If the market's down and interest rates go down, they can borrow cheaper, they can buy back stock, they can push the market back higher doing that. The other key component here is when it gets cheaper for them to borrow out longer term, then a lot of these other high flyer names, Microsoft, Apple, Google, Amazon, they're almost private equity firms, right? They can get in and acquire. They almost want to see a sell-off, right? They want to see interest rates go lower and a sell-off, because now they can acquire companies at a cheaper rate and build up their portfolio of growth returns through acquisition. And so in a sense, everybody then is tied to valuations off of that. And there's where that interest rate trickle down effect. We have a newsletter on calling it sort of the butterfly effect or the ripple effect. When you drop a bowling ball in a pool in the deep end and the wave moves, it eventually makes its way to the shallow end. It might not be as big, but it'll make it there. So there is a domino ripple effect that occurs even with interest rates to big cap tech and then down to the more growth, smaller cap names.
Love it. So you at first traded options at CBOE and then moved into the VIX, right?
That's right. Yep.
Do you ever feel like there's a better, how do you manage that dichotomy between the options and the VIX? Like in theory, sometimes you could go into the option market and get better, right? The SPX options and get a better value, so to speak, than buying the VIX futures. So do you play that game and look for the relative value there, or you're just focused on the VIX futures?
No, we do that, under unusual circumstances, as we're seeing in the markets over the last few days. There is opportunity that presents itself to do that, to make that switch. When I talked about, owning straddles or puts or strangles is sometimes difficult. Well, sometimes it's not. And it's just a matter of finding the right balance of seeing realized volatility occur. When you get a pickup in realized volatility, sometimes the S&P can present itself as a nice place to sort of hedge yourself out and play volatility in that sense. But if volatility becomes muted, then it becomes more difficult to use that, and the VIX becomes a better place to trade.
And then how do you view in the blended product, right, that has the beta plus the VIX exposure? Does that have is it 50 delta or 80 delta, or what? Do you have a delta target on that?
Yeah, I mean, so in that sense, that our beta strategy, we trade Nasdaq and S&P futures, mostly a lean towards S&P 500 futures to be long the market, and we trade our EA vol methodology, the index that you see on the CBOE. We're buying VIX futures against that, and we're trying to keep the notional value of the two balanced out at the ratios that we talked about, percent changes, moves in the VIX versus a percent change in the S&P, looking to balance that accurately so that it provides a hedge should the market move lower.
But it doesn't have a set, like, that's why I was going from the VIX futures back into the options, right? So if you're buying those straddles and whatnot, you're going to have some delta component, but you're saying, no, it's just to try and even out if I lose 10% here, I want to be gaining 10% here.
No, I mean, in that type of strategy, we actually have a long market bias. We actually offer that strategy as a more efficient way to be long the S&P, right? I mean, you could buy the SPY and pay the 5 or 10 basis points management fee and just be long the market. Yeah. What we think is there's a more efficient way to do that. So we want to be long the market. We want to provide market-like returns at 20% less risk. And the reason we're able to do that is we actually dial up, instead of 100% long the market, we're actually longer the market, more like 130% long the market. But then we're holding VIX component, right, to hedge out the 130. And what we find is that we actually participate almost in line with the market going up, maybe a little bit better, and we reduce drawdowns by 20% or so. So now we've created a dynamic that's a more interesting way to be long the S&P 500 than just blindly buying it and riding the roller coaster.
Love it. And then, so does that aim is to reduce volatility as well as drawdown, or just drawdown?
The aim is really to reduce drawdown, right? So if we can create this asymmetric return where my beta to the downside is a 0.8 beta to the downside, but a 1 beta to the upside, I mean, that's the home run, right? That's where you get, all the geeks out there, the Sharpe ratio, the Colmar ratio, all those ratios, whatever, start looking really good when you can change the beta profile. Whereas if you're owning the S&P, you're 1 beta to the downside, you're 1 beta to the upside. That's it. Yeah. You're riding the market. But if we can give you the same 1 beta to the upside, but only a 0.8 beta on the downside, that's a more efficient way to be long the market.
And in theory, you're risking the 1 beta in order to remove it on the downside, right? So you might have a 0.9 to a 0.8 or something.
Exactly.
Like that's the trade-off of the risking to the upside beta.
Exactly. And so what we want to do is give people, if I'm someone that normally was in a portfolio and I like, I'm a little bit more conservative, let's say, and I want to be 80% long the market and 20% bonds, okay? Because I only want 80% of the risk of the downside, right? And I want the bonds to protect me. Well, basically our beta strategy gives you that level of risk to the downside, but now I'm actually giving you 100% of the upside. If you look at what we've done over the last couple of years in that strategy, right? So I'm risking the same to make more, is really what it comes down to in terms of, how to, devise a plan to invest in that kind of strategy.
So that's important because, right, if you're talking to an investor, hey, I'm trying to get equity-like returns with less risk, or here we're saying we're going to get equity-like risk with more return.
Right. So that, that really depends, that's just a matter of going from like 1x to 2x our beta strategy, right?
Yeah.
The 1x strategy is give somebody, a 80-20 risk profile that normally is in that lifestyle category, but give them 100% of the upside, right? Is where you kind of start with. So we're always giving you a higher level of upside versus the same amount of risk you're willing to take on the downside.
And talk through a little bit, right? Like we're making it sound pretty simple, right? Like, oh, I'll just go do this on my own. I'll buy SPY. I open a futures account. I trade the VIX against it.
Yeah.
Like talk through why it's harder than it seems. Like
one main thing is the rebalancing act that occurs, right? Because when the VIX goes from 20 to 35 and back to 20, did you on a daily basis take advantage of that to harvest the crop, right? So that I can put it back into the market. That's a very key component, especially when we're seeing wild swings like we see, on days like today or last couple of weeks, right? So the harvesting of the crop component is very key because the VIX that you're owning, remember, it's a mean reverting product. It's going to go back to not return anything for you. So you got to take advantage of these daily moves versus the long-term outlook. And that's the main thing that makes it difficult. The second thing is just how do you buy VIX and not become a VXX and see it decay away 98% to the downside over a long period of time. That's the other part that, needs a little bit of massaging as well.
And so you open up a little nugget there. So every day you're harvesting that, or not necessarily, right? That worries me because now if it went from 25 and it goes to 80 and I got out at 25, didn't I leave a lot on the table, or how do you view that?
Yeah, I mean, the thing with VIX that's really tricky is I always say you never know when the merry-go-round is going to stop, when it's going to stop spinning. So at some point, you have to do some harvesting. The key component in the harvesting, though, is that as it's going up and you're price averaging out of the VIX and buying the market, yes, maybe it starts to go against you. But we're keeping that percent relative to each other. So in other words, let's just say I have $100, I'm long $90 of the market and $10 worth of VIX, right? That ratio we kind of maintain so that if the market keeps going, we're not blasting out of all our VIX. I don't think anybody ever wants to do that because, like I said, you don't know where the merry-go-round is going to stop in volatility, right? Whether it's March 2020 and you go to 80, or is it 2018 February it goes to 45-ish, 48 and comes back down. But it's maintaining that 9-to-1 ratio of the two, let's call it, with each other. That is the key component in the daily rebalance.
And so then by definition, you'll never perfectly rebalance, right? On every move to 25 and back to 15, you're going to miss some, and then you're never going to have everything on all the way up to 80 either.
Right. Yeah. So, I mean, there is a little bit of science to that, whether you let some of that run a little bit or not. The key thing is if you can sort of maintain the relationship, like I said, that 9-to-1, 8-to-1 relationship or so with the two, then you're going to have the daily hedge on. And then doing some of the rebalancing of the weights back to that norm allows you to sort of take advantage of the pops and drops of volatility. And by time the VIX has sort of made that round trip up and down, as long as you've averaged out of the VIX and averaged back in, typically what you find is after that time, you're actually up. Like a great example was 2020, right? We're selling out of the VIX a little bit as it's going up. Our EA vol, if you looked at it, was about unchanged on the entire year of 2020, right? The markets were up, S&P were up like 13%, but our strategy was actually up more, right? So the only reason we were up more was because we captured and harvested all that volatility back up and down. And capture 3 to 5% or whatever a year on rebalancing the mean trading, you're adding alpha.
Have you done that research? I'm sure. What does that look like in terms of daily rebalancing versus monthly versus quarterly versus annually, right? Annual would make no sense at all for the VIX, right? Because right, it could totally revert and you miss the whole thing. But at the same time, if it reverts and the market came back, maybe right?
We looked at daily, we looked at monthly, we looked at annual, and sometimes it works, sometimes it doesn't. What we found really is somewhere in between a daily and a monthly is really where you want to be at. And if you really want to be tight, the daily is probably the best way to go. But you could leave some level of room to rebalance, on trader feel. I kind of feel like in some degree, I mean, we kind of stick to that daily rebalance, but there are, moments in time where as a trader, I've found that I have a pretty good feel of the VIX and, I can maybe let it go or not go. Sometimes I've rebalanced it 3 or 4 times in the middle of the day. In 2020, I couldn't stop trading. Over this last month or whatever, I haven't been able to stop. I've rebalanced a couple of times in intraday because of the wild swings of the market. So it really depends on market conditions, how you're going to play that rebalance.
Got it. And so that makes it less systematic and more just, hey, the goal is to capture that and redeploy it versus the goal is, like you said, with the ETFs or it's just time-based and I'm doing this and that leads to problems.
Exactly. There has to be somewhat of a dynamic feel to it. I mean, we have a systematic methodology to hold VIX, but the rebalancing part is something where, you need to rebalance it appropriate, act in times when you need to, pull back a little bit if you want to as well, and manage that structure and not be on this set it, forget it kind of thing.
So where do we go from here? We talked a little bit about rate hikes. We talked about feeling a little bit like 2008. Say this week hadn't happened and the whole Russia thing hadn't happened, and just talking about the Fed. What do you think for the rest of the year?
Well, it's kind of interesting because I think we've been in such a dynamic over time where, we've wanted the Fed to rescue us and lower interest rates to save the market. The thing is throughout that period of time, we were in a flat to deflationary, let's call it, kind of world where inflation wasn't a factor. Now it's quite the opposite, right? We have this inflation pressure. I actually think the market wants the Fed to hike rates 50 basis points. I think if the Fed came out today and said we're hiking rates 50 bips, I think the market would actually go up. The opposite would almost happen. And when we were trading in the floor, we'd always say, don't fight the Fed. And we would say that because if they lowered interest rates, you wanted to get long the market. But that was in a non-inflationary environment. We had a whole boom of technology keeping inflation lower. Now we're not in an environment. And so I think if the Fed actually raises rates, the market might actually like that.
And what about with volatility? So if they keep rising rates, the market likes it. Does that dampen vol? Or where do you see, you mentioned before, you kind of see it settling in the 20s for the rest of the year?
I do think it dampens vol. I mean, I don't want to see the yield curve invert, so if the yield curve's kind of, meaning the interest rates of the 2-year versus the 10-year, if that can sort of kind of stay maintained, I'm okay with that. But as you've noticed, the more that the Fed does nothing, the flatter that yield curve has been going, right? And so typically when that has inverted, that's been an indication of a recession coming. And so I actually think when they hike the rates, the yield curve, I think, will maintain itself. The back end actually might go higher, which is not great if you're a bond investor. But sorry, if you're a commodity investor, sorry about that. But I think commodities will get hit hard. They'll hike rates, and I think the market will rally off of that because it's asking for it. I think that's what the level of volatility in this market's all about. And I think you might see the VIX come off and back down to that 20 level.
Yeah, it was super weird this morning to see, right? Stocks bright red and energies, everything else risk on was bright green. Was quite a difference from usual of like stocks are down, oil's down, grains are down, everything's down, as a risk off play.
Yeah. Although it was actually kind of interesting this morning when you looked at big names out there, the big oil names, energy was actually down when the market was down. Not as much as the market, but it was down, which was to me kind of strange.
Yeah.
Maybe people are kind of sensing that oil $100, okay, it's maybe gone far enough.
Yeah, I think we'll start to see real world effects with that. And I think I probably lost a bet somewhere in the last 5 years that we'll never see $100 oil again.
Well, I can tell you this: when I was in the pits, when during the Obama era, 2000, or when he was coming in, what was it, 2008, just before he won the election, over the summer of 2008, oil was at like what, $140 or whatever. We had a bet in the pit, call it Trading Places bet of $1 that I'm like, mark my word, oil is going back below 80 and going to stay down there for a long time. And a few months later, it happened.
Nice. Well, it's hard to believe, right? 2 years ago, we were at negative 40. Negative 40 to 100. It's a good trade. We'll let you go here, but last bit, give us your hottest take if you have one, something nobody else is talking about, something everyone's talking about, but you're 180 degrees on the other side of it.
I think like I just mentioned before, I think when we need the Fed to take some action here, we can't let the inflation continue. It's opened up the door to places like Russia, who profits greatly off of owning gold, which they have, off of owning grains, they're the breadbasket of the world, off of owning oil. Places like that, when they see inflation, they smell, their chance to go in for the kill, right? We need some of this inflation to back off. And like I said, I think if the Fed comes in and raises rates, I think the stock market's going to love it. And I think that sort of stops the volatility bleed to some degree, as long as those rate hikes are somewhat systematic and people see them continually coming to get some of this inflation out, get some of this commodity pressure that's being created in the market, because it's becoming more and more difficult for companies to pass that buck on to the consumer. And so, if it gets more difficult to do that, what does that mean? Profit margins get squeezed, versus if rates are higher and we can sort of, crap out the commodity markets, that might be a positive for the overall stock market.
I always want, yes, you can raise rates. Yes, historically that's lowered those commodity prices. But at the same time, if the industries, the people, if everyone still needs those goods, right? So to me, I don't know how much you dampen that demand unless we're saying the rising of rates just eliminates a lot of speculative demand.
Yeah, I think it takes the speculative flavor out of it. Maybe it's not raise the Fed funds rate. Maybe it is just stop the bond purchasing, what they're doing, but actually pulling back some of the money supply as well. But there's all this speculation bubble that's occurring in those markets. You've got to pop that market, and I think if you do that, then you're going to see profit margins in companies go up.
Right, but is that financial speculation, like futures traders like us, or are we saying like because the money's so cheap and they're building new condo buildings in Miami and so right there, that whole knock-on effect of.
Yeah, I mean, it's made everything cheap to do all of that, right? And so, what people then have clamored towards is things that they need, right? Because there's this bubble that occurs and people pile into the trade, and there's a lot of speculation, I believe, in it right now. On top of, I mean, yes, we increased the money supply dramatically in 2020, right? Some of that's got to come out of this market. The markets can't be at all-time highs, and you maintain that money supply in the marketplace. And so, what was real and what was not, there might be some levels of a little bit more volatility to go, but I think you'll get a big carpet shakeout and the markets will move higher after we hike those rates and take some of the supply out.
Love it. All right, let everyone know where they can find you and find all the good Equity Armor stuff. You guys redid your site, like, was that a year ago now? So there's some cool content on there, I know.
Yeah, we're always keeping it up to date. Our guys, myself, publishing media all the time. I'm on Nasdaq Talk, on CBOE TV, on some of the other channels out there. Some of my colleagues as well. So lots of content that we produce for people to just kind of see our insight on how we're trading the VIX and volatility, and it's important for people to follow along. So we're excited to have you.
Got it. And what's the website again?
EquityArmorInvestments.com, and Armor is ARMOR. And when you go on there, by the way, we launched a book that I wrote about option trading. It actually goes over some of our times on the floor and compares how we use those times with, teaching a lesson about option trading, very basic kind of stuff. But, if you don't want to learn about option trading, some of the stories of the war stories on the trading floor are in there, and you can pick up a free electronic copy of the book when you go to our website and sign up. So feel free to stop in there.
Give us a teaser. What was one of those stories?
Well, we talked, one of the funny ones is just, I traded a buyout. Dreyer's ice cream, if you remember, was bought out by Nestle's. And there was a whole big hubbub about ice cream, right? And one of the funny things was, was the buyout going to happen? And was our government going to approve being taken over by a European company,
right,
for ice cream supplies?
So that was kind of a fun one. Was a U.S. company?
Yeah, Dreyer's is a U.S. company, and Nestle being the European company. And so a lot of activity on the call option side to the upside, whether the buyout was going to happen or not. And there were some lessons to be learned just about binary situations that occur, whether it's going to happen. It's either yes or no. There's no gray area. Value is going to slowly go up. And so that was kind of a fun one to try to trade under. The other funny thing that made it even funnier is you're trading ice cream, and the pit was literally, so the S&P 500 pit, real quick story, is built up on stairs, right? And it's a massive pit, hundreds of guys in the pit trading it, really loud. The Dreyer's ice cream option trading pit was literally underneath the staircase of the S&P. So you're like in this little, under the staircase, as if you're like under the bleachers at your high school, trading this buyout thing that was quite active with all this noise going on, that where Dreyer's it didn't matter what the S&P was doing. Dreyer's had its own deal. So that was
probably just a couple $100 million market cap, right? Was it relatively small? Yeah. Was it part of the S&P? I guess, yeah.
I want to say it was not part of the S&P at the time. So
I don't think I ever had Dreyer's. Buyers, or what's that one? Breyers, yeah. No, Dreyer's was it was a hard ice cream, sold at stores. So it was a fun one to be at. There was maybe 5 to 10 guys in the pit. It was very active, and big, broker dealer players that came in there, which made it kind of fun to trade.
But it was kind of a funny situation.
Love it. All right, go pick up the book. I'll read a copy, and we'll talk to you soon.
All right, great.
Thanks, Brian.
Thanks a lot. Thanks for having me.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.